Billionaires don't pay capital gains tax every year on their massive investment portfolios. They simply move their money into a special account that allows it to grow completely untaxed year after year until they decide to access it, and even then, they often borrow against it tax-free. You see, the wealthy aren't just earning more, they're operating under an entirely different set of rules for how their capital compounds. By the time this explanation concludes, you will possess a clear, detailed understanding of private placement life insurance, or PPLI. Not just what it is, but precisely how it functions as one of the most powerful and understated tax avoidance mechanisms available to the ultra-rich, enabling them to bypass annual investment taxes and drastically reduce estate taxes on their enormous fortunes. The bedrock of virtually all personal finance advice centers around tax-advantaged accounts like a 401k or an IRA. These structures allow your investments to grow without immediate taxation, deferring income tax until withdrawal, and providing a powerful boost to compounding returns. But these accounts have strict annual contribution limits, typically capping out at tens of thousands of dollars per year. For someone accumulating millions or even billions, these limits are utterly trivial. They represent a fraction of 1% of their investable capital. Imagine having a personal balance sheet measured in 9 or 10 figures. How do you shield that kind of wealth from the annual drag of capital gains taxes, which can erode nearly 40% of your investment profits each year at the federal level alone, not to mention state taxes? This is where the less common, highly specialized world of private placement life insurance enters the picture. Think of PPLI as a highly customized, ultra-high net worth version of a traditional variable universal life insurance policy, but stripped down, optimized, and supercharged for investment growth rather than a simple death benefit. Unlike the standard life insurance policies marketed to the general public, PPLI is designed specifically for accredited investors and qualified purchasers, meaning individuals with many millions in investable assets. These policies are not sold through typical retail channels. They are accessed through specialized private wealth managers, often embedded within family offices or exclusive financial institutions. The key distinction lies in the investment options. While a traditional variable life policy offers a limited menu of mutual funds, PPLI allows access to a vast array of sophisticated, often institutional-grade investment strategies, including hedge funds, private equity, and highly customized portfolios that are otherwise inaccessible to individual investors, even wealthy ones. The structure is simple enough. You contribute a significant sum, perhaps several million or tens of millions of dollars, into the policy. This sum then goes to work in your chosen investment vehicles. Have you ever considered how profoundly the tax code influences investment behavior? It's not just about what you earn, but what the government allows you to keep. If decoding these hidden financial systems and understanding the true mechanics of wealth creation helps you see the world more clearly, consider hitting the subscribe button and leaving a comment. It signals to the algorithm that this knowledge matters, and it helps this channel continue to pull back the curtain on these often opaque mechanisms. Now, back to how this peculiar structure operates. So, you funded your PPLI policy, and your investments are now growing. But what exactly happens to those annual gains and dividends that would normally trigger a tax bill? Here's the core mechanism, the fundamental advantage that elevates PPLI far beyond standard investment accounts. All investment growth within the policy, every single capital gain, dividend, and interest payment accumulates tax-deferred, not just for a year or 5 years, but potentially for decades over an entire lifetime. This means that unlike a taxable brokerage account where you might owe taxes on your gains every single year, often at a rate of 20% for long-term capital gains, plus the net investment income tax, perhaps totaling 23.8% federally, and then your state income taxes on top of that. None of those taxes are paid annually inside a PPLI. Your money compounds upon itself, entirely untouched by the Internal Revenue Service. Imagine two identical portfolios, each starting with $10 million, invested in the same strategy generating an 8% annual return. The first is in a standard taxable brokerage account. Every year, a portion of its gains is immediately siphoned off by taxes. If we assume a combined federal and state capital gains tax rate of, say, 25%, then only 75% of those gains are actually reinvested. Over 30 years, that account might grow to just under $60 million. Now, consider the second portfolio, nestled inside a PPLI structure. It too earns 8% annually, but because its growth is tax-deferred, 100% of those gains are immediately reinvested, compounding without interruption. After 30 years, that PPLI policy could easily exceed $90 million. That's a difference of more than $30 million, purely due to the magic of uninterrupted tax-deferred compounding. That nearly 50% increase in terminal value isn't from superior investment strategy, it's from superior tax strategy. And it gets even more impactful. When the policyholder eventually needs access to their funds, they typically don't withdraw directly. Instead, they take tax-free loans against the cash value of the policy. The insurance company lends them money, using the policy's value as collateral, and because these are loans, they are not considered taxable income. This means you can access a significant portion of your accumulated wealth without ever triggering an income or capital gains tax event. The loans are usually repaid from the death benefit when the policy eventually pays out, further insulating the policyholder from tax obligations during their lifetime. What most people don't grasp is that for the ultra-wealthy, this isn't just a loophole, it's a fundamental shift in their economic reality. This incredible tax efficiency also extends powerfully into estate planning. Most people are keenly aware of the federal estate tax, which currently imposes a hefty tax on estates exceeding a certain exemption amount, an amount that, while substantial, is easily surpassed by billionaires. Estates worth tens or hundreds of millions, or even billions, face a federal estate tax rate that can reach over 40%. Think about that. Nearly half of your lifetime's accumulated wealth can be claimed by the government upon your death before it ever reaches your heirs. It's a truly significant erosion of legacy. However, when a PPLI policy is structured correctly, often by having it owned by an irrevocable trust, the death benefit, along with the entire cash value, passes to the beneficiaries completely free of estate taxes. This means that not only did the investments grow tax-deferred for decades, but the ultimate transfer of that wealth to the next generation occurs without the 40% haircut from Uncle Sam. It's a double shield, one protecting growth during life and another protecting transfer after death. So, what does this highly specialized mechanism mean for you, for the broader economy, or for understanding the landscape of modern capital? First, it fundamentally alters the long-term investment calculus for the ultra-wealthy. When you remove the annual tax drag on capital gains and dividends, you dramatically increase the power of compounding. This isn't just a minor optimization, it's an accelerant that allows already enormous fortunes to grow even faster and reach even greater magnitudes than publicly available investment vehicles would permit. It widens the gap between those who can access these structures and those who cannot, creating a separate, more efficient financial universe for the 1% of the 1%. Second, it incentivizes long-term capital retention within these structures rather than regular distribution. Because the benefits are maximized through sustained tax deferral and eventual tax-free loan access, there's a strong incentive to keep capital locked within PPLI policies for extended periods, potentially across generations. This means a significant portion of the nation's wealthiest assets effectively become less visible to the traditional tax system, transforming how intergenerational wealth transfer functions in practice. It's not just about avoiding tax on income, it's about shaping the very flow of capital across decades. Third, it highlights the enduring power of structural financial innovation in wealth preservation. PPLI is not a new invention, but its continued relevance and optimization illustrate how sophisticated financial engineering can persistently adapt to tax codes, creating avenues for wealth to circumvent conventional taxation. This isn't about evasion, it's about astute legal structuring that utilizes existing frameworks, revealing a parallel financial system designed specifically for extreme wealth. It's a stark reminder that while the average person might focus on maximizing their 401k contributions, a different class of investors is playing an entirely different, far more intricate game. You now see private placement life insurance not as a complex financial product, but as a critical piece of the infrastructure that enables billionaires to operate on a financially privileged playing field, one where their capital compounds with unprecedented efficiency and transfers across generations largely untouched by taxes. It's an understanding that most people never acquire, leaving them blind to a core mechanism of modern wealth accumulation. How do you think this tax-deferred compounding impacts wealth inequality? Let me know your thoughts in the comments. And if decoding these kinds of hidden economic mechanisms helps you understand the world around you, please like this video. so you can easily find this explanation again the next time PPLI or similar wealth strategies come into public discussion. The next time you hear about the vast sums accumulating at the very top, you'll understand that it's not simply about earning more, but about having access to an entirely different set of financial rules. Stay tuned as we continue to pull back the curtain on these obscured systems, because there are always more layers to peel back, more hidden strategies at play, and more forces quietly shaping the economic landscape that most people never even perceive. Subscribe now so you don't miss the next critical revelation we uncover.